Well, I think a lot of it is just eco-related, obviously, the data. And also, we're seeing just a grand divergence in monetary policy that's just starting to unfold. And so that in mind, we're probably going to continue to see dollar appreciation against low-yield currencies, which would be like the euro, yen, Canadian dollar, and less so against the high-yielding currencies, the Mexican peso. So, I mean, that's it in a nutshell. It's funny. It's taken 6 months for this all to unfold, something that has been a very, very crowded trade. But just really the divergence in monetary policy has just caused this to happen just in the last month or so.
So just in terms of, you know, the data in particular, I mean, because the jobs was seen as, you know, less than expected, but some of the detail in it was positive. You know, just what's your view on that in particular, that on-farm payrolls read? Yeah,
I think that really gives the Fed a lot of room next Wednesday, I believe, the 17th, when right now that's being debated about the zero interest rate policy. What's Yellen going to say? What are they going to change? All that to say, it's still different than what's going on in Europe with eventually they're going to have some type of sovereign bond purchase when the economy starts to heal. So that's what's going on right now, but it's being just vehemently being debated right now in the U.S.
I mean, what could it involve, this change to the statement? I know you were talking about the removal of the words perhaps considerable time then.
Yeah. Yeah, that's something that people are talking about because they're wondering, are the markets behind me? Are they pricing in the first interest rate hike being June, July correctly, or is it going to happen a lot sooner than that? But let's keep in mind that last Friday's jobs report just kind of solidifies the output gap that we're still facing here in the U.S., that things aren't as great as they appear. They're better than they seem, but not great as they appear. So that said, it still seems like we're on track for a second quarter, early third quarter interest rate hike next year.
Let's get your view then on all of the various asset markets and what you think. Just firstly on equities, because European equities certainly seem to be out of favour. That seems to be the view coming through from investment managers, given the worries for the European economy and now the Scotland vote thrown in as well. Just on that compared to US, because the view on the US also seems to be that it's resting at the moment, if you like. So what do you do?
Yeah, and that's a great way to, that's a great way to put it. Because right now, look at what happened last week. U.S. stock market was flat. We had pockets of Asia up pretty well, pretty considerably, and Europe was up a little bit. So I think there's a divergence in value purchasing around the globe in the equity market. I mean, our market here in the U.S. has gotten ahead of itself a little bit. The least path of resistance to me would be 20 to 30 points down. My year-end target is still 20 and a quarter in the S&P 500. So when you look at multiples in Europe, they're sub 15 right now, which is about 2 turns better than the U.S. And you're seeing China multiples at 9 or 10 times earnings. So that's where the value is right now. And I think people just looking elsewhere right now, not because our economy is bad, but because there's pockets of value elsewhere.
And just on currencies then, how are you playing that? Just coming back to the dollar rally that everyone seems to be on.
Yeah, I mean, I'm very careful. I pared down a lot of it because it seems to be a very consensus trade and just due for a big snapback. But still, the low yield trades make sense to me. Long the dollar versus the euro, CAD, Canadian dollar, and the Japanese yen, vice versa against the Mexican dollar right now.
And looking at the commodities as well, because we've been watching Brent, below $100 a barrel, down another % in the session there. What's your view on those commodity markets, particularly energy?
Yeah, especially with oil, I still think oil is going to see a bounce back, and the market is underestimating the supply risks, especially out of Nigeria, Libya, Algeria, etc. There is, a lot of production here in the U.S., but refineries are at capacity. So I think the underestimation is going to just give us some type of snapback soon.
Got to ask you too about Apple, such a talked about stock and a huge mover, both up and down in the end, closing just down in trade today. But what's your view on the announcements today, what it means for Apple?
Well, you know, like you said, it had a $7 range today, and I think the big downer here in the U.S. was availability of the iWatch. I mean, the stock was trending higher than when they talked about the iWatch wasn't going to be available until after the holidays. That really put a crimp in things, and the stock went south. So that said, I still think it's a great stock, great company, a pile of cash, and a good long-term buy. It just got a lot of headline risk today, especially with the iWatch. People were expecting it to be available before the holidays.
Okay, yeah, that's something great to watch. Great point, Larry. Thank you so much for that.
You're welcome.
Larry Shover.